Ackerman Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Ackerman's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at ackermanresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. Welcome back to the show, Rick.
It is always a pleasure, Jim. Thanks for inviting me.
Rick, a study done in Canada by an economic analysis expert for one of the banks said the monstrous debt load that the average Canadian is carrying is going to catch up to the economy at some point and knock our dollar down from about 75 cents US to 62. Could something like that happen in the US, where their personal debt maybe isn't as high as Canada, but it's still pretty reasonable, and the US government is much, much higher in debt than it is in Canada?
Well, the crux of my doomsday scenario is that debt is going to push the dollar much higher. And it comes about on some day when one or two obscure banks fail to open, and it throws the whole clearing system into a mess. And at that point, none of the short-term paper that rolls from one day to the next is going to clear. And that's going to put pressure on debtors to settle up these short-term claims in cash. So all who owe cash will be pressed. It will have what we have in the stock market sometimes, which is a cash market to avoid settlement problems. Sometimes you'll see that a stock like Boeing will be quoted after hours, 375 bid, offered at 380. But that, if you do that in a normal way with 3 or 4 day settlement, I can't remember exactly how many days, it might not work to give you deliverable stock against perhaps options, call options that you were short. So you wind up going in the cash market and paying $500 a share for Boeing that will settle instantly. Mm-hmm. So I think that's what will happen in the credit markets, and it's going to put a short squeeze on a dollar that will increase its value enormously and put all who owe dollars in a very difficult position.
So that just means the person who's taking a loan out in the U.S. would be in trouble?
Well, more than that. I mean, it's to people who argue that we're going to hyperinflate away these unpayable debts. My response is, do you actually think that the banks and mortgage lenders are going to allow people to skip free and go naked, essentially to be in a position of peeling a couple $100,000 bills off their wallet and telling their mortgage lender, hey, this is it, I guess we're even now? That's not going to happen. And since mortgage debt is really sort of where the rubber hits the road, or meets the road, it's going to be a major factor in determining the course of our inevitable financial Armageddon, whether it's inflationary or deflationary. I've never thought there was much chance of a hyperinflation.
Well, both the Canadian and U.S. governments seem to happily skip away after running up huge deficits with no plans on how to get back to a balanced budget. When is that going to burn all of us?
With the pension system collapse that's coming, you can say, oh, yeah, Ackerman, you've been talking about this sky is falling thing for the last 30 years, but it's going to happen, and it really has to, simply because the pension problem's not going to go away. We've got, particularly the state of Illinois, I think that's the first one that's going to go, but we've even had acknowledgments from Christie when he first came in as governor of New Jersey. He said the teacher pension system is going to break us. and it will. And the problem is, well, you have a lot of people who say, "Oh, yeah, the federal government will step in and they'll take care of it." But the fact is, in those situations, you have to substitute the word taxpayer for government. So when you say, "Oh, the government will bail us out," what you're saying in effect is the taxpayers will bail us out. But that's a big part of the problem already, is that we have so many working stiffs that are paying big taxes just so that, that government employees can retire at 55 or 60 and collect pensions till we working stiffs are 80 or we die. We're finally off the tax hook there. So it's easy enough for the federal government to monetize the financial system. We see that all the time. That's what quantitative easing is. And the idea is that you just put enough credit into the system that it makes it possible for any number of borrowers to bid financial assets up to ridiculous heights. But if you talk about bailing out a pension system, that's real money. That's actually helicopter money, and it means it would have to be shoveled out the door. I mean, you literally have to have dropped shipments of packages of $100 bills to bail out the pension system, because these are money checks that go out to recipients every month. And so you're talking about not just the usual credit bailout and asset inflation. You're talking about ongoing expenses that have to be covered from one month to the next. And you can see where that slippery slope leads if we bail out the state of Illinois.
Right. We also have the Canadian federal government brought out its budget yesterday, and they have a lot of looking ats. For example, they're looking at a national pharmacare program, but no costs associated with it yet. They're looking at guaranteeing your private company pension, so if the company goes bankrupt, you still get your pension. But looking at and actually doing something, those are two really totally different things. We might as well say we're looking at putting every Canadian on the moon. It's just as realistic.
And I think it works a little bit like the FDIC. You can bail out 1.5 good-sized banks or whatever, but as soon as a couple more come into the equation, you're out of money. And fortunately, we haven't needed a mass bailout in the financial collapse of 2007, 2008. They bailed out a few players, and then they pronounced a couple others, like Bear Stearns and Lehman. They said, "Well, you guys are dead. You don't get to play anymore," and that saved us from a run on bailouts that would have broken the system.
Mm-hmm. Of course, now we have legislation for bail-ins where, although the banks don't pay you dividends right now, they certainly have the right to dip into your account to settle any financial difficulties they may run into. Bail-ins.
That bail-in has become part of the discussion. It's a scary new word that's entered the language. I think probably from the time when that little bank in wherever it was, Cyprus or
yes,
or that there was a bail-in there. The idea that rather than go out to seek some federal bailout, that the people who are shareholders or bondholders in the bank, they're the ones who are going to take the hit.
Right, and the bail-in hit anybody with more than a certain amount of money in a bank account. The rich people apparently heard it was coming, so they took all their money out in advance, and the average people were left paying the bills.
Well, that's what a deflation would look like, really. It would be a massive bail-in, because ultimately a debt deflation would visit the problems of debt deflation on borrowers according to the magnitude of their sins. So, in a way, the deflation is a way of settling those accounts in an equitable way. People would be obliterated as debtors according to how much unpayable debt they had personally accumulated. So deflation deflation is kind of a neat solution, whereas hyperinflation just makes big winners out of everybody who owes. And ultimately, everybody's a loser, because hyperinflation would ultimately collapse into a deflation. And conversely, a deflation that puts the world in perhaps a state of barter would lead ultimately to a hyperinflation where there's a huge premium paid for real goods and things we need to sustain ourselves in terms of whatever is passing for money at that time.
Now, I wondered, of course, we think of the German Weimar Republic back in the 30s, where you had to pay billions of marks for a loaf of bread. But whatever happened to that? Did Hitler just say, well, that's it, that's over, and we're back to a regular set of currency? How was that ever settled?
Well, the actual hyperinflation in Germany took place between, I think it was April in 1921, and I can't remember what month in 1924, but up to a point in 1921, Germany was actually in a deflation. And the irony was that Germany, among the countries that fought in World War I, Germany's economy was going pretty well. I mean, Britain was on its back, and Germany at that point was willing to do whatever it took to maintain relatively full employment. So the hyperinflation of Germany, when it really took off gradually, and then it steepened over that period into 1924. But it required a level of complicity between the German government and, for one, major employers that could probably not exist here. So over the period where the German hyperinflation occurred, if you go to the web and you call up maybe 800,000 pages about the German hyperinflation, none of them get it right. The only place I've seen which really, instead of simply saying, oh, and the Germans just cranked up the printing presses, the only place where you have it explained is in Adam Ferguson's book. I think it's called When Money Died. And if you read the book, you'll understand why the mechanism, the instrumentality that created that German hyperinflation it's unavailable here, not politically or not even logistically. So in Weimar, the Weimar Republic, you had a collusion between the government and major employers, and the idea was that if your boxcar of money didn't arrive on a given Friday to pay your employees, the companies themselves were authorized to print scrip. So over the hyperinflation period, there were just 2 times when the printing presses literally broke down. The government wasn't printing money, so the employees launched into that scrip option, and it is during those relatively short intervals where employers printed their own money where the German hyperinflation actually steepened. So you know, it was wide scale collusion between the government, the big employers, and the unions, and the government's its goal was to make sure that they didn't have those times when nobody would get their paycheck. So there's just so many differences between what happened in Germany and what we could possibly propagate here that to me the hyperinflation is impossible.
We'll have more with Rick Ackerman right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Welcome back. We're speaking with Rick Ackerman. Rick, a lot of people I talked to thought the markets would be doing well until we hit March, but they still seem to be okay, kind of churning, sideways, flat, but still nothing big going up or down. How long is this going to last? We're kind of in never land.
That's a great question. We are, because you can see that the market valuations flout common sense in so many ways. You can say that things shouldn't be trading this high because we've really got a very clear global slowdown, both in Europe and China. And the U.S. seems to be above it simply because the stock market has remained relatively strong. But the catch-22 there is it's been strong in part because of the flow of money from outside the U.S. into the U.S. It's not quite a flight to safety, but it's definitely a flight toward higher yields. So the U.S. market has remained strong then for the absolutely wrong reason, and you get sort of a feedback loop there where, because the market's strong, it actually does keep the U.S. economy stronger than it would otherwise be. So it just seems like things are still nutty, and a couple of key stocks that tend to be very supportive, that keep the market buoyant when they're buoyant, are also suspect. Boeing is one, and Boeing is a major project right now of its institutional sponsors. They'll do anything to keep it to turn it around. And there've been a lot of cross currents with Boeing. Something in the Journal the other day about competition with Chinese aircraft manufacturers, or a budding industry there. But also we've got this fallout from the two crashes, the fatal crashes of 737 MAX 8 aircraft. So Boeing is I'm amazed that I use the word they with a capital T, are able to keep Boeing afloat. Apple has continued to move higher, even against a story that you're now getting cell phones produced in Apple's major market outside the U.S., China, that can do everything an iPhone can do at half the price. So Apple, just a couple months ago, before this rally kicked off, said, well, we're going to do better, but no one has really pinned them down as to specifics. And Facebook has also had a nice rebound against some heavy, you can make a very bearish case for Facebook in that the millennials are starting to desert it because of the privacy concerns, but also just because Facebook is becoming less cool. Tesla, I don't think Tesla is going to dodge the bullet here. I've got a 252 target on it. It's now trading 269. But so it feels like we've got a lot of major support operations going into a relative handful of stocks, and the idea is you pretty up just a few of them, and it'll sustain the illusion that this bull market can go on forever. But I think that the huge rally we've had since December is just a big bear rally, and it may have to go to new highs to suck everybody in.
We'll have more with Rick Ackerman right after the break.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Don't miss out. Stay informed Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Rick Ackerman. Rick, if we're in a bear market trap, does that mean that everything looks like it's going fine, then all of a sudden they cut the elevator cables and you're into a sudden plunge?
Yeah, everything's going to look fine up till the very last when it stops looking fine. With respect to some of the major U.S. indexes, we're in bull trap territory because the most recent piece of the rally from February on has gotten through a few peaks that were made on the way down in respectively October, November, December. So now that we're sitting above those peaks, it looks like the broad averages have broken out, and they're preparing for a break above the all-time high that was made in the final days of September, early October.
Well, people have used that old saying, sell in May, go away. Should you take a hike when things get harsh in March?
Probably yes. I mean, statistically, that the case for go away in May it's overwhelming. I can't remember the exact numbers, but if you had simply been out of the market from May till, well, I saw something recently that said that it's not even getting back in September. I think you can wait till pretty well into December before you actually jump back in. So that period where over the last 100 years investors have made their best returns, it's a relatively narrow window, a relatively small number of months.
And so really the stock market for most of the year is not a good place to be in?
Oh, it's been awful. I think, again, the statistics they're just amazing. You see that if you had been in the market over just the bad months over the last, whatever it is, 100 years, you would not have even made a positive return, a real return. And yet, if you were in during not even just 5 months or four good months, but over a period of maybe 10 weeks or something, you would have made, who knows what it is, 70-80% of your gains.
So maybe the way that we invest needs to be re-examined and look at that particular timing.
Well, if we all do that, and I mean all of us,
yeah.
The benefits will reverse themselves. I mean, that's the nature of the market. If everybody looks at Yale Hirsch's calendar book and says, well, it's time to get out, then whatever situation obtained to create that statistic is going to be turned on its head.
Rick, is there any particular area we should be looking at right now?
Well, I tend to focus just on the key, what I call the lunatic stocks that are controlled by the big institutional buyers. They get a lot of credit for being geniuses, but of course everybody's a genius in a bull market, and their genius is somewhat limited to this idea: if you throw a lot of money at just 6 stocks, everything will look good. So I'm focused on Apple, the FANG stocks: Facebook, Apple, Amazon, Netflix, Google, and I'm looking for a break there. I had kind of written Apple off as a market leader because of all the problems that it faces competitively. The idea of trying to sell $1,300 cell phones when they're under such heavy competition from Asian manufacturers. But somehow the boys have cranked up Apple strongly enough that it's leading the market. The stock is currently just a hair beneath 187, and I'm using a target in it at 190.33. So when it gets there, I may do a little drum roll and say, hey, we better be careful. This could be it. But I'm just kind of focused on a few stocks to tell me when things might be topping, because these are all canary mines. Or, I'm sorry, mine mine canaries.
Yeah, it's hard to mine those canaries. Those deep, dark canary mines of South America. Rick, thank you so much for chatting with us.
Well, it has been a great pleasure, Jim. Again, thanks for inviting me on.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website rickackerman.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet, our YouTube channel, Talk Digital Network. If you have questions for Rick or any of our other guests, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.